Today we will discuss about bonds, what are bonds and types of bonds, etc. Okay, so you know that there are two types of instruments which a company can raise for raising finance. One is the equity instrument, and another is the debt instruments. Okay, a company can raise funds from public either by these two ways, equity or debt instrument. In equity, there will be equity share capital will be there. Okay, equity share capital. And in debt, we will be having bonds, debentures. Okay, then you can say loans taken by bank, that will also be long-term debts, etc. Term loans. And one more thing is that preference share capital. Okay, as per the new accounting standards, preference share capitals are also debt instrument only. They are not equity instruments. So in equity, there will be only equity shares issued by the company. In bonds, debentures, then loans taken by company from banks, long-term loans, then preference share capital, all will be debt instruments. What is the main distinguishing feature between an equity instrument and debt instrument is that equity instrument will give ownership interest in the company. Okay, if you are investing in an equity share capital, you will get the ownership interest in the company. But if you are investing in a debt instruments, debt security, there will be no ownership instrument. Okay, because debt holders are like creditors of the company. Okay, they are like the creditors of the company. Only if equity instrument, if you are investing, or you are investing in convertible instruments. Okay, sometimes if you invest in debenture, it is convertible to equity shareholder, so that will also be classified in equity only. For time being, we are not assuming that. Just understand, if you invest in equity instrument, you will get the ownership interest. Okay, if you will invest in debt instrument, you will become creditors of the company, but you will not receive the ownership interest in the company. Okay, so foreign investment, direct investment or portfolio investment are always equity instruments only, because they will give the ownership interest in the company. No? Foreign direct investment, we have seen, it will give the ownership interest. So it should be always equity instrument or convertible instruments. It cannot be debt instruments. By investing in a debt instrument, you cannot get the ownership interest. So it will not become a direct investment. So till now we have seen direct investment or portfolio investment. It should be always equity instrument only. It will be always equity instruments. Okay. Now another form of raising finance by companies through issuing debt securities. Okay. And what are debt securities? Basically bonds, debentures. Okay, these are traded in markets. Then you are having the loan which will be taken by the company from the bank. Then preferential capital is nowadays classified as debt instruments. Now, what is the distinguishing feature between an equity instrument and debt instrument? First is the ownership interest will be given by the equity instrument. And another thing is that debt instrument will be having a fixed cash inflow. Okay, if you invest in a debt security, you will get a regular interest from the company, and you will get the amount back after the specified number of years. This is the another distinguishing feature between equity and a debt instrument. In an equity instrument, you will not get regular cash flow. Okay, and you will not get the amount also back which you have invested. In exceptional cases like buyback and winding up, you will get back the amount, but otherwise you will not get the amount back in equity instruments. But debt instruments are always redeemable. Redeemable means if you are investing in a bonds of a company for 5 years, means after 5 years you will get back your amount. That is one thing. And every year for 5 years you will get interest also. So there will be always two cash flows in a debt instruments. Okay, from investor point of view. So if you are investing in a bonds of a company, you will get the interest, regular interest will be there, which is known as periodic interest, and you will get the amount back after the number of years. So this is one of the feature of debt instruments, debt securities. But in equity, that feature is not there. There will be no regular inflow and amount also will not be repaid back. Okay, so let us understand what is bonds. Bonds are what? Debt security. Very important and understand this. Bonds are debt securities. They are not the equity security. They will not give the ownership interest. So bonds are debt security where the issuer, that is company, is bound to pay specific rate of interest. This is very important. So if company is issuing bond, it will be bound to pay specific rate of interest. Okay, agreed as per the contract. This is one thing. And he should also, company should also repay the principal amount at a later time. Okay. One thing is that there should be periodic interest payment will be there, and the second thing is that the principal amount should also be repaid after the maturity period. So these two things are very important in case of a debt security. Okay. Bonds will also include debentures also. Okay. So what are bonds? Bonds are debt security where the company who is issuing the bonds is bound to pay specific rate of interest. First thing, he should pay the interest. And second thing is that he should also repay the principal amount after the specified number of years. So bondholders are like creditor. Bondholders are like what? Creditor. This is a very important point. Bondholders are creditors, they are not owners, where the company is obliged to pay the amount. Okay. So suppose if you're investing in a 5-year bond in some company, so you will get for 5 years, you will get interest every year, regular interest will be there. And at the end of 5th year, you will get the principal amount also repaid. Okay, so this is a very important feature in case of bonds. That's why we say that debt instruments are less risky than equity. Less risky than equity. Debt instruments are what? Less risky. Debt instruments are less risky than security. Okay, they are less risky. Why? Because you will get the regular interest and you will also get the amount back. Okay, that's why from return point of view, always equity instruments will provide a high return because they are risky also. So we know no, more risk means more returns. Okay, so if you want high return, you should go for equity instruments. If you want to play safe, that is, you want regular in returns, and you don't want to take that much risk, then you can go for the debt type of securities. If you are interested in investing in a companies, okay, so that's why bonds or debt security are generally said to be less riskier. That's why they pay less returns also. Equities are highly risky. That's why they pay high returns. Okay. Only thing is that in equity there will be no regular inflows, cannot be guaranteed, because dividend will be paid only if there is profits, but they will have an high returns also. Okay, but bond holders or creditors, you will have company will have to pay the interest. If there is profit or not, they will have to pay interest because they are creditors. They are not owners. So this is the meaning of bond. Bond is an debt security where issuer will pay the specific rate of interest and he will also pay the principal amount at an agreed time. So this is the bonds. Now let us discuss some characteristic of bonds. What are the features of a bond or a debt instrument or a debentures you can say. First is a bond has a fixed face value. There will be one fixed face value to the bond on which interest will be paid. So on face value interest will be calculated. Okay, on face value interest from a bond will be calculated, which is the amount to be returned to the investor upon maturity. Okay. Then second feature is it will have a fixed maturity date will be there. Suppose if you are investing for a 5 years, means the bond will be redeemed after 5 years. All bonds are redeemable. So all bonds repay the principal amount after the maturity date. Bonds are always redeemable in nature. They will pay regular interest. Either it can be annually or it can be semi-annually. Okay. Interest is calculated. This we have already discussed. Interest is calculated as a percentage of face value. Interest is known as coupons. So in bonds, interest is called as coupon payment. So coupon payment means nothing, means interest payment only. So technical name for interest is coupon. Okay. Generally considered less risky investment as compared to equity. Okay, so bonds are less riskier compared to equity instruments. So these are the characteristic of bond. It will have a face value on which we will calculate the interest, and interest is called as coupons. All bonds are redeemable. They will pay regular interest. Either it can be semi-annual interest or annual interest. Interest is known as coupons. Technical term name for interest is coupon. Bonds are generally considered to be less risky as compared to equity. So these are the characteristic of a bonds. Let us discuss about types of bonds. First type is government bonds. Very simple. Government bonds means what? Those bonds which are issued by Government of India or public sector units. Public sector units means those companies in which are owned by Government of India. Okay, like ONGC is there. No, it is a government company. Popularly it is called as government companies. Okay, ONGC is there. Then we are having Indian Oil Corporation, etc. Such type of companies are public sector companies, means which are government owned companies. So if such companies issuing bonds to public, it will be called as government bonds. Or sometimes government can also issue bonds, okay, to raise funds. So all these things which are all the bonds which are issued by government or public sector companies, that is government companies, that will be known as government bonds. So as you can understand, government bonds, they are the highly safe instrument you can say. Okay, because government will never default on payments. So sovereign bonds, that is government bonds, are highly safe instruments because they are backed up with the security from government. Okay, so in government bonds, there will be no default risk. In any case, there cannot be default risk. You will surely get back your amount. Okay, if you are investing in government bonds, etc., it is a highly safe instrument because they are secured and backed up with security from government. Very important. Since this is a high safe instrument, rate of interest will be low rate. Okay, since risk is not there, so both the things you cannot get together. If you want to be safe, you will have to take less interest, or if you want high interest, then you should take a high risk. So we can say that these bonds generally offer low rate of interest compared to other types of bonds. So simple, government bonds means what? Those bonds which are issued by government or which are issued by government companies or public sector India, public sector units or central public sectors, we say, by such companies. If any bonds is issued, then it will be government bonds. and these are always backed up by government security. They are very less risky and rate of interest will be low. So this is the government bonds. Then another you can classify as corporate bonds. It will be opposite. Corporate bond means those which are issued by private companies. So government bonds we have seen those bonds which are issued by governments. So corporate bond will be those will be issued by private companies. For example, Reliance Industry, private company, if it is issuing bond, it will be known as corporate bonds. Okay, in India, corporates issue secured as well as non-secured bonds. Secured bond means those bonds which will have a security, and unsecured or non-secured means which will not have any securities. Okay, like your secured debentures and non-secured debentures. Very important, whenever you are issuing in a corporate bonds, that is a bonds of a private company, you will have to consider the credit rating given by credit rating agencies in India. What is a credit rating? Very important thing. Credit rating is the rating given by a credit rating agency. Like for India, in India we are having credit rating agency CRISIL. It is a credit rating agency. Credit rating agency means what? They will give ratings to the bonds issued by the company, bonds or debentures, etc. That this bond is safe or this bond is highly risky, etc. Okay, rating will be given in grades like A plus plus. So if any debt instrument is having an A plus plus rating, means it is highly safe bonds, you can say. So you can invest in this bond. Okay. Likewise, if some bonds is given A plus rating by CRISIL, which is a credit rating agency in India, so you can say it is also safe investment. Okay, like A, all these are good category bonds, debt instruments. Like then will come B plus plus, like that. It will go on. So suppose a investment is given C rating by credit rating agency, means you will have to see it is highly risky. Then you will have to take your decision whether you want to invest or not invest. So always before investing in a corporate bonds, you will have to take care of the credit rating given by the credit rating agency. Credit rating agencies are independent bodies, so they are not related to the company. One thing you understand, they are independent. So credit rating given by them will be independent basis. Okay, they are not related to the company which is issuing the bonds. Okay, if they are related to the company, then it cannot be relied. No, so credit rating agencies are always independent bodies, you can say. So one credit rating, many credit rating agencies are there. One credit rating agency is CRISIL. Okay, they will give ratings to the debt instruments issued by company, whether it is safe for investment or whether it is highly risky or whether it is moderate, etc. So you can consider that rating and accordingly take your decision before investing in these bonds. Then banks and other financial institution bonds, those bonds which are issued by banks, financial institutions, etc. It will be known as banks and other financial institution bank. And majority of bonds in India market are from this segment only. So bonds by financial banks and financial instruments. So if some bank is issuing bond, it will become bank bonds. So you can say. So for today we will be stopping here only. Further discussion on bonds, that is what is foreign currency convertible bonds, etc., euro bonds, etc. We will be discussing in the next class. So for today we will be stopping our discussion here only. In next class we will discuss about foreign currency convertible bonds. Okay.